Something unusual is happening beneath the surface of the global economy, and the most important part of it isn't what policymakers are saying publicly, but what markets are quietly signaling behind the scenes. Inflation is cooling, not accelerating. Employment is weakening, not strengthening. Growth is slowing, not overheating. Yet central banks across the world continue to speak as if the greatest danger ahead is another inflation surge waiting to explode. That contradiction is not accidental, and it's not harmless. It is the defining macroeconomic risk of this moment, and it is already reshaping markets, currencies, and global power dynamics. If you only followed official statements and press conferences, you might believe tariffs are about to unleash a new wave of consumer price inflation. You might think the global economy has proven its resilience and earned a prolonged pause in easing, or even a return to tightening. But if you look carefully at the data, not selectively, not emotionally, but comprehensively, a very different picture emerges. It's a picture markets already understand, even as policymakers resist acknowledging it. The November CPI report in the United States should have ended the inflation debate outright. Instead, it exposed just how deeply embedded the inflation narrative has become. Headline CPI didn't rise. It didn't even stay flat. It slowed materially. Core CPI didn't remain sticky. It cooled sharply, reaching the lowest year-over-year pace seen in several years. This wasn't a rounding error. This wasn't noise. It was broad-based disinflation cutting across multiple categories at once. And this wasn't an American anomaly. The United Kingdom reported nearly identical results at the same time. Headline inflation dropped for a second straight month. Core inflation followed it lower. Expectations were missed decisively. At the very same time, payroll losses in the UK accelerated sharply. Tens of thousands of jobs disappeared in a single month. The unemployment rate surged past official forecasts. GDP weakened again. This is not theory. This is confirmation. Europe tells a similar story. The European Central Bank has already cut rates down to 2% and now claims it is finished. Officials repeatedly describe the economy as being in a good place. Some even suggest the next move could be a hike. That confidence is not being driven by strong growth or rising demand. It's being driven by one simple observation. Nothing collapsed immediately when markets wobbled earlier in the year. From that single fact, policymakers concluded that downside risks had been neutralized. But economies don't work that way. Avoiding an immediate crisis does not eliminate structural weakness. It often means the damage is spreading more quietly. Job losses do not arrive all at once. They accumulate slowly. They erode confidence. They change consumer behavior. And once that process begins, inflation fears lose relevance very quickly. Markets understand this distinction. Central banks increasingly do not, or choose not to. Inflation expectations priced through the bond market are falling, not rising. TIPS break-evens are declining. Yield curves are bull steepening. Not because growth is accelerating, but because disinflation is returning and future rate cuts are being anticipated. Risk assets have become more sensitive to labor data than CPI prints, which tells you exactly where the real stress lies. What we're experiencing now is not inflationary pressure. It is demand exhaustion. Consumers are pulling back, not because prices are high in absolute terms, but because income security is deteriorating. Jobs matter more than CPI when it comes to sustained pricing power, and jobs are weakening across multiple economies at the same time. You can see this play out in real consumer behavior. Companies believed certain products were immune to demand destruction. Prices were raised, sales collapsed. Gaming consoles, discretionary electronics, non-essential goods, all experienced sharp pullbacks in spending. In a strong economy, higher prices stick. In a fragile economy, they fail quickly. That failure is exactly what current CPI data is capturing. This pattern is not new. In 2018 and 2019, CPI spiked briefly. Trade war fears dominated headlines. Inflation warnings flooded the media. Central banks prepared to tighten further. Then the economy slowed, markets warned early, and inflation faded on its own. The same arguments being used now were used then. The outcome is repeating. What makes this cycle more dangerous is timing. Central banks are attempting to pause or sound hawkish just as labor markets roll over. Historically, this is when policy mistakes cause the most damage. Rate cuts do not instantly revive weak economies. They lag. And when policymakers mistake survival for strength, they risk tightening financial conditions indirectly through rhetoric alone. This is where geopolitics enters the equation. Monetary policy is not just domestic economics. It governs capital flows, currency stability, debt sustainability, and political cohesion. When developed economies misjudge their own cycles, they export instability outward. Emerging markets are forced into defensive postures. Currency mismatches widen, debt stress intensifies, trade tensions reemerge. So here is the geopolitical question that truly matters right now. If inflation is fading globally and labor markets are weakening, why are central banks so determined to appear hawkish? The answer is simple and uncomfortable. Because sounding hawkish preserves institutional authority in the short term, even if it undermines economic stability in the long term. Hawkishness signals control, it signals confidence, but it does not signal accuracy. Admitting disinflation also means admitting fragility. It means acknowledging that rate cuts are not stimulus, but damage control. It means recognizing that the global economy is far more dependent on financial conditions than policymakers want to publicly concede. That admission carries political costs, so it is delayed as long as possible. Markets, however, do not wait for permission. Capital moves ahead of narratives. Bond curves move ahead of press conferences. And right now, capital is positioning for slower growth, lower inflation, and eventual policy reversal, whether central banks admit it or not. This is why rate-cutting cycles rarely end cleanly. They pause, they restart, they accelerate unexpectedly. Policymakers insist they are done until reality forces them back in. Once easing begins in a disinflationary environment, it almost never stops where officials expect. History makes that painfully clear. What makes this cycle unique is the scale of narrative resistance. Inflation bias is deeply embedded across institutions, media, and policymaking frameworks. Even as CPI falls, the story persists. Even as jobs vanish, the warnings continue. That is not because inflation is real, it is because the alternative is harder to admit. The real risk now is not runaway inflation. The real risk is policy lag combined with narrative rigidity. And when those two collide, adjustments happen faster and more violently than expected. Uncertainty is not coming from the economy itself. The data is becoming more consistent, not less. Disinflation is spreading, employment is weakening, growth is slowing. Those trends are coherent. The uncertainty is coming from the refusal to acknowledge them. The global economy did not escape downside risk. It delayed it. Surviving one shock does not eliminate vulnerability. It simply shifts it forward in time. Quiet deterioration is more dangerous than loud crisis because it invites complacency exactly when vigilance is needed most. And that leads to the final geopolitical reality. The world is not fragmenting because inflation is out of control. It is fragmenting because growth is becoming scarcer, debt is heavier, and policy mistakes are becoming more consequential. The nations that recognize this early will adapt. The ones that cling to outdated narratives will be forced to react under pressure. If you want to understand where markets are heading, do not focus on what central banks hope will happen. Watch what capital is preparing for. Right now, capital is preparing for slower growth, lower inflation, and policy reversals that officials still deny. That is why this moment matters, not because it is dramatic, but because it is quiet. Major turning points in the global economy do not announce themselves loudly. They unfold while attention is fixed on the wrong risk, and that is exactly where we are now.